I've been trading GBPUSD for the past few years, and many people ask me how I trade it, why I trade London session, and why I basically trade that pair after many years of trading with gold. Firstly, it fits better time-wise. Setups for me, when I was trading gold, 9 times out of 10 would happen in New York session. But I wanted it so that my trading was, I go on the charts in the morning, I'm able to see if there's a setup, and then after I'm able to see if there's a setup or not, I can decide to set an alert or perhaps set a pending order. And if none of those things actually tag in or are set off and giving me an alert, then I will just close the charts and enjoy the rest of the day. Whereas if you're trading London session and also New York session, or let's say you're solely trading with gold or GBPUSD in New York session, then you're going to have to basically wait until the afternoon to then trade. So you kind of can't really choose what you're going to do that day until you see if there's a trade later in the day for that New York session. So that's one of the main reasons why I chose London session. And I do feel like you should try to fit your trading around your life, because if you're just doing it based on pure data, you can end up actually working more hours, spending more time on the charts than you would at a job, and you could be potentially earning less as well, which would not be an ideal situation, because people often get into trading to break free from that sort of lifestyle. So if you're just using it to go back into it to earn less money, then again, you might want to reevaluate your choices. So I'm going to show you a quick example of a trade that I actually had yesterday, so Monday the 4th of August, and I'm going to put up a screenshot here of the profits, and this is the strategy I've been using for the past few years. I go into full detail in my mentorship. Obviously this is going to be a light overview, giving you a few tips that I would actually implement and be aware of. But if you do want the full strategy broken down into every individual piece, how to build your trading plan, how to backtest the strategy, how to actually backtest every single confluence, entry, stop loss, take profit, and obviously you can ask me questions too, check out the mentorship in the description. But without further ado, let's get into the video. So I have actually written down 3 points here, and it is quite small, so I'm going to enlarge that for you. There you go. So London GU. And we have 3 major points that I'm actually going to cover in this video. Firstly, we have the breaker structure. Secondly, we have the target placement. Target meaning take profit. Some people call it target, some people call it take profit. I usually call it a target because that is where I want price to actually go to. So I'm targeting that area. Your take profit could be anywhere along the way. That is why I won't call it a take profit, because if price suddenly breaks structure in the opposite direction, that will be where I take my profits. So I say target is more fitting rather than take profit, because you, like I said, you don't know when you're going to take profit. And then we also have deep retracement, and that's kind of the key thing that we're going to focus on in this video. It's very, very clear to see in London session if there is a breaker structure. So we can quite quickly see on this trade here that this is the London high, or the high at the moment. And if we're looking to actually take a long position, we're going to look for price to break this high. The same goes for the downside too. So this is the low here. So if we're actually looking to take a short position, we want price to break down through this low. So we're going to add the text in here, London low, and we're going to add some text up here, and we're going to call it the London high. You might be thinking, if the London session isn't over, you can't know the highs or the lows. But if we're looking for a break of London session, some people might trade on the highs and lows of Asian session or the previous New York session, or there's various different ways people are actually looking to trade nowadays. But for this video, we're going to say that London low breaks, we're selling, that London high breaks, we're buying. Very, very simple. And this is what you can do just on the charts. And let's say price has already broken the high, but there's no retracement, then again, you can just close the charts and go about your day. You want that kind of process where if this happens, you do this. And if this doesn't happen, this is what I can actually do. Because then it does kind of eliminate the confusion and the time wasting just staring at the charts for absolutely no reason. You don't want to be on the charts if you don't have to be. So we're going to click through price here now. We are on a 50-minute time frame. I forgot to mention that. And we're going to see what happens. So you see we have this bullish push at the moment. And there we go. Some people might say that this was the high because of the wick. But if you've been watching the channel for a decent amount of time now, you will know that I always focus on the bodies and not the wicks. I couldn't care less where the wick is. So let's say this is the wick here. The wick could be all the way up here. Hopefully you are able to see this. And then price closes here. That's still a break of structure for me, as long as the body closes above the previous body. I don't care if the wick's up here or not. I'm only focusing on the bodies. And this is something that I found through lots of testing, that wicks just don't really seem to matter. There are situations where wicks matter because you are getting stopped out of trades. And if this does happen frequently and you are able to see it over a large enough sample size where you can make an effective change, then you can look at wicks. But in the kind of process of seeing if there's even a trade going to be valid, I discount wicks from my evaluation of a high or a low, basically. So here, now what we're looking for is, like we said here, a deep retracement. The majority of people that get into trading, and you guys probably know this too, they buy here. And where they put their stop loss, probably down this area here. And then let's say they target a 1 to 2. And this could work. I'm not saying this couldn't work, but you can quite clearly see from the previous area, this break and push up here. So this area, this push up of these 4 candles is virtually identical to this push up with these 3 candles. And what happened when price actually came up like this? Well, it came up with a nice push with no interruptions, 4 nice candles breaking the previous structure. And then we had a deep retracement. We didn't just retrace up to here. No, we had a deeper retracement. So that is what I'm going to be looking for on this setup. I don't want to retrace the high, because then if price does have a deep retracement, I can get in lower. And if I can notice how to get in lower over the long term, which is what I teach in my mentorship, then you're able to get into trades. So you're able to get into trades much later down of the bearish move. And it does also massively increase your risk to reward. So let's say hypothetically, we got in this level here. Our risk to reward has now gone from a 1 to 2 to a 1 to 4.78. So we've over doubled the potential payoff of this setup just by increasing my entry by around 16 pips. Obviously that is quite a large increase, but it's definitely possible for that to be the way you trade, because that is exactly how I trade. So we're going to delete that off there. And the area I actually got into this trade was, I think, around this area here. And I actually have a preset here for a 1 to 3 risk to reward. And you can quite clearly see that for me to have a 1 to 3, I don't have to aim all the way up here like you would do if you had that 1 to 2 risk to reward that I showed you initially. And this was kind of my entry. I think it was around this level here. Very, very nice. 10 pip stop loss, 30 pip take profit. And when we talk about target placement, this is again something that is very, very key, because you don't want to be targeting all the way up here. Some people would be like, oh, that's the closest high, so that's where I'm going to target. And when I'm seeing people trade, people that have these outrageous targets, the likelihood of you hitting 90 pips, 100 pips in a London session is not very high. So if you are able to lower your target size, but as a result, this increases the amount of times your trades actually go to take profit. If the calculation shows that it's more profitable to have a smaller target, then I definitely would recommend you do this. I'm going to give you an example of another strategy I have. I was testing it, and I was testing 0.5, 1, 1.5, and 2. So 1 to 0.5, 1 to 1, 1 to 1.5, and 2. And the reason I was actually testing this was because I noticed the win rate was ridiculously high. And when you have a high win rate, you can sacrifice the risk to reward. If 1 to 2 was more profitable, I'd obviously take it. But because the win rate is lower for a 1 to 2 than it is a 1 to 1, just based on it's obviously quite simple why that is. Price is going 20 pips instead of 10 pips. Price is more times going to go to 10 pips rather than 20 pips, because it has to travel 20 pips instead of 10. So it's double the distance. And what I noticed was, as I was increasing my risk to reward, the profits were actually going down. My drawdown was increasing. My win rate was obviously dropping as a result of this. And you kind of need to find the sweet spot. There's not going to be one that is perfect for every single strategy. But for me, I realized that 1 to 3 was the perfect one for my strategy. I could target a 1 to 10. I could target the previous high from however long ago, which a lot of people actually do. But I'm only focused on this session here. And at this session, when I'm actually setting my limit, when price is at this sort of level, I don't have a high to target. So I had to come up with something that would make it so that I had somewhere to target. I had an area to put my stop loss that meant that I wasn't sacrificing to have a 1 to 0.7 risk to reward on my trades. But I'm okay with having a low win rate as a result of this. So I did settle on 1 to 3 risk reward, which worked out perfectly for me. And as you see, price retested in and we hovered around this area, tagged me in. We did have slight drawdown on this trade, but again, that is completely normal to have drawdown on a trade. Then we play price on and we did end up hitting the take profit for a full 1 to 3 risk to reward. And like I said, if you actually got in at this area here, stop loss below this level, you obviously would have been fine, but you're not going to make as much profit. The risk to reward is just not as good as a 1 to 3. So again, you can make profit, but you won't make as much profit. So that is a simple breakdown. And when I say simple, I mean very, very simple, kind of just outlining my thought process behind some of my trades. And like I said, if you are looking to learn how I trade and how all these traders are making their profits, check out the link down below to my mentorship, and also check out this video here, and that will also be very useful to you. And if you did enjoy, like the video, and I'll catch you guys in the next one.